What if everything you know about the 1929 stock market crash was a lie? What if every textbook explanation, every documentary you've ever seen, was carefully designed to hide the one thing that actually mattered? What if the losses weren't the real story, but the timing was? And what if that timing, down to the week, down to the hour, was only visible to the 1% of the 1% who were quietly watching a shadow machine beneath Wall Street calculate the exact moment the American public would break? Because here's the part the official narrative never tells you. Most Americans never had access to the truth. In this fictional retelling, the real engine wasn't irrational exuberance or speculation. It was the shadow leverage system, an off-book, invisible lattice of synthetic promises and leverage multipliers that could inflate an ordinary investment by 10, 20, even 100 times, while hiding every one of those risks under a dozen layers of paper. You feel the consequences of this kind of financial illusion right now in your inflation, your debt, your wages that don't stretch the way they used to. Because the system might look modern, digital, clean. But in this fictional account, it was born in 1929. Before we dive in, a quick community check-in. Where are you watching from? Drop your city in the comments. And if you want more long-form breakdowns like this, the kind that peel back the curtain on the official version, hit subscribe. You'll get weekly deep dives into the unfiltered alternative history truth. Alright, let's go back to the beginning. To the lie underneath all the others. Picture Wall Street in the late 1920s. Not the sterile, marble-polished version we see in documentaries. No. Picture cramped offices thick with cigar smoke, telephones ringing nonstop, and crowds swelling outside brokerage houses just to read the latest tape. The American dream was being sold by the minute. Stocks were only going up. Everyone was a genius. Everyone was a future millionaire. Sound familiar? The story we're told is simple. People invested too much, borrowed too much, and the bubble popped. But that's only the surface, the PG-13 version. The real story in this fictional retelling involves a mechanism hidden beneath the floorboards of the entire financial system. Let's break down the myth first. We're told that margin accounts allowed people to borrow 10 times what they invested. Banks lent recklessly. Stock prices inflated beyond earnings. Then fear spread, and the market collapsed. Clean. Simple. A morality tale about greed and caution. Except that in this narrative, that explanation is about as deep as a puddle, because the numbers don't match the consequences. Not even close. The crash wiped out over $30 billion in market value within weeks, over $500 billion in today's dollars. Factories closed. Farms collapsed. Banks vanished. Wages fell. Gold reserves evaporated. Trade froze. Entire cities starved. All because people overborrowed on stocks? That's almost exactly how the 2008 crisis gets explained. People took bad loans. Banks shouldn't have lent to them. Whoops! As if entire economies collapse because average people make irresponsible decisions. There's a pattern here, a comforting lie. Every time the financial world implodes, the blame is always placed on speculators, irrational exuberance, unsophisticated investors, retail mania. It's always the public. Always the 99%. We hear this after every crisis. 2000, 2008, 2020, and even in fictional future collapses. But here's the twist. In the fictional world we're building, Wall Street knew far more than the public ever could. They didn't just predict the collapse. They didn't just see the bubble. According to this narrative, they engineered the leverage that created it. Let's go back to 1929. Only a handful of firms mattered. Harrington Brothers, Liddell and Company, Rockford Securities, Benton Chase Trading. These names are fictional, but they stand in for the kind of dominant broker-dealers who controlled the flow of information, credit, and most importantly, leverage. These firms didn't just participate in the market. They were the market. They controlled order routing, margin requirements, clearing processes, settlement windows, and broker-dealer reserves. And beneath all of this sat something the public never saw. In this fictional retelling, the core of their advantage was the shadow leverage system, a private handshake-based network of synthetic loans and promises that multiplied market exposure hundreds of times beyond what regulations allowed. Imagine a broker saying, "You have $1,000 in your account? Sure, we'll let you trade like you have 10,000. But what if the broker himself was borrowed 10 layers deep? And what if that broker had promised the same capital to multiple other brokers? And what if all of this was settled not in cash but in trust? It created a system where $1 could pretend to be $10. $10 could pretend to be 100. And by 1929, $100 could pretend to be 1,000. It was leverage built on leverage built on leverage, a hall of mirrors where everything looked solid from a distance. Sound familiar? Credit default swaps, synthetic CDOs, rehypothecation, but we're not there yet. Let's stick to the 1920s. The newspapers printed optimistic headlines. Peak prosperity. A stock for every man. America's golden age of growth. But while the public was watching the front page optimism, the real elite were staring at the back office numbers, the ones that measured liquidity, settlement lags, and counterparty exposure. Here's where the fictional narrative pushes deeper. Because if the shadow leverage system existed, a hidden architecture of synthetic promises designed to prop up stock prices, then someone had to build it. It didn't appear out of nowhere. It wasn't an accident. And it certainly wasn't created for the benefit of ordinary Americans. So who built it? According to this alternative history interpretation, it starts with one man, a figure who appears quietly in footnotes, letters and private memos scattered across the archives of several old brokerage houses. Not a banker, not a tycoon, not a politician, a mathematician, a young quant decades before that term existed. A man whose obsession with leverage models would change the trajectory of the Roaring '20s, the crash that followed, and the entire future of American finance. His name, at least in this fictional reconstruction, was Calvin Mercer, a 32-year-old statistician who realized something terrifying. Markets didn't move based on fundamentals. They moved based on pressure points, liquidity thresholds, cascading margin calls, and synchronized leverage unwinds. He discovered that if you could calculate the precise moment when a critical mass of synthetic promises would be forced to unwind, you could know exactly when the market was going to collapse. And if you knew when it was going to collapse, you could exit early, you could short from the top, you could transfer wealth at a scale the public could never comprehend. Mercer didn't call it a collapse model. He called it the liquidity pressure curve, a mathematical formula that forecasted systemic failure before any retail investor had the slightest clue. And in this fictional retelling, 4 of the most powerful broker-dealers on Wall Street gained access to it. They didn't warn the public. They didn't reduce leverage. They didn't pull back their synthetic positions. No, they accelerated them. Because once you know the moment everything breaks, the fastest way to accumulate power is to push the system toward that moment. But the real twist? Mercer didn't just create the model. He left behind a document, a single handwritten sheet containing the name of someone even more powerful who commissioned it. And that's where part 2 begins, because you won't believe the name on that paper. The receipt is wilder than you think. Last time, we talked about the shadow margin pyramid, a fictional web of financial trickery that let Wall Street spin a single dollar into entire empires of fake buying power. But how did this imaginary system actually work? And why did its collapse drag the world into the Great Depression, costing millions their jobs, shuttering thousands of banks, and making entire generations believe that poverty was their own personal failing? Let's pull back the curtain. On the surface, everything looked simple. You had your regular folks, your retail investors. Someone might put down $1,000 of their own money, borrow $9,000 from a broker, and buy $10,000 worth of stock. If the stock went up just 10%, boom, they doubled their initial investment. But that was the regulated world, the one everyone could see. The real game, the one the elite played, happened in the shadows. This is where the fictional shadow margin pyramid came into play. Let's call it step 1, the collateral loop. Imagine you own 1 share of stock. You use that share as collateral to get a loan from broker A. But here is the twist. Broker A then takes that same share and uses it as collateral for their own loan from broker B, and broker B does the same thing with broker C. Suddenly, 1 single share is backing 3 different loans, each treated as if it were backed by fresh, unpledged capital. 1 share. 3 loans, 3 layers of risk stacked on top of each other. Let's look at the math of this fictional system. A single $100 share could be used to support a $1,200 loan at just 1 firm. When that same share was passed through 3 different firms, it created a combined exposure of $5,400. And once it was pyramided throughout the system, that single share could support up to $14,000, in systemic leverage. That's a leverage ratio of 140 to 1, all on paper, and the scariest part? It was all invisible. It was off-ledger. And it was technically legal because there were no rules against it. This system created what I call phantom liquidity money that didn't really exist. It generated artificial buying pressure, pushing stock prices up for no fundamental reason. This led to self-reinforcing price spikes. Stocks weren't rising because the companies were more valuable. They were rising because this hidden machine was constantly printing synthetic demand out of thin air. It was greed masquerading as prosperity, an illusion disguised as growth. The market wasn't a reflection of the economy. It was a reflection of its own internal fabricated momentum. Now someone eventually noticed. Step 2. The internal warning signals. In our fictional story, a brilliant mathematician named Edwin Werner started mapping the flow of risk. He analyzed ledger timestamps and the routing data for this cross-pledged collateral, and he discovered something absolutely terrifying. He found that once the level of synthetic leverage in the system surpassed an 80-to-1 ratio, massive liquidation cascades became a mathematical certainty, not a possibility, not a probability. A certainty. It was like a row of dominoes. Once a single brokerage failed to make good on a collateral promise, the entire pyramid was guaranteed to collapse. The system had become so interconnected, so dependent on this chain of borrowed assets, that one broken link would bring the whole thing down. Werner presented his findings in a stark warning. The market will begin collapsing when the Dow Jones Industrial Average hits 360. On September 3, 1929, the Dow hit 381. 3 firms received Werner's memo. And what did they do? They didn't sound the alarm. They didn't warn the public. They quietly began to unwind their positions. They sold off their assets, cashed in their chips, and left the party just before the lights went out, leaving everyone else in the dark. They knew the crash was coming because the system was designed to crash. And then came step 3, the trigger. The history books tell us the panic started with margin calls on October 24th, Black Thursday. But the key event wasn't the sell-off itself. The real trigger in our fictional account was the sudden withdrawal of synthetic credit. When one major firm refused to honor the cross-pledged collateral from another, the entire liquidity chain froze solid. The machine ground to a halt. What the public saw was chaos. They saw screaming headlines, waves of panicked selling, and brokers jumping out of windows. But what was actually happening behind the scenes was far more clinical. The credit oxygen that had been fueling the market was completely cut off. The shadow machine collapsed in on itself. Every single inflated dollar, every bit of that phantom liquidity evaporated in an instant. Think about it this way. A stock that was trading at $500 didn't fall to $50 because its fundamental value disappeared overnight. It fell because the 9/10 of its price that was pure leverage, pure synthetic credit, simply vanished. The prosperity that everyone thought was real wasn't destroyed. It was revealed to be an illusion all along. The wealth hadn't gone somewhere else. For most people, it had never been there in the first place. Now, this is where the story gets uncomfortable, because it stops being about the past and starts being about the present. We love to tell ourselves that 1929 was a closed chapter. We learned our lessons. We corrected the mistakes. We put regulations in place to make sure it could never happen again. But have we? Let's look around. Today, we have something called rehypothecation, a complex term for a simple idea. The rules allow for the unlimited reuse of collateral. Sound familiar? It's the same core mechanism as our fictional shadow margin pyramid, just with a fancier name. We have a derivatives market with a notional value estimated at over $600 trillion, a number so vast it's almost meaningless. It's a global casino of bets layered on top of other bets. And the leverage cycles that once took weeks to build through telephone calls are now driven by high-frequency trading algorithms that operate in microseconds. The margin calls that once came from a human broker are now executed automatically by liquidation bots. A local bank panic in New York in 1929 has been replaced by the potential for a global liquidity cascade that could freeze the entire world's financial system in minutes. The game didn't disappear. It just evolved, it got faster, it became digital, it went global. If the crash of 1929 was a spark that lit a fire, the next one has the potential to be a nuclear event. Because today, synthetic leverage isn't some backroom experiment conducted by a few rogue firms. It's the very backbone of modern markets. It's embedded in everything from pension funds to exchange-traded funds. If the fictional shadow margin pyramid collapsed at a leverage ratio of 140 to 1, what happens when today's real systems, with their 300 to 1 rehypothecation chains and $50 trillion derivative webs, finally hit a snag? What happens when AI-optimized liquidation triggers all fire at once? Are we actually safer now? Or are we just better engineered for a much more spectacular collapse? History doesn't just repeat itself. It's not a simple cycle of mistakes. It's a cycle of extraction. The public is always fed the same simple stories. Greed caused it. Panic caused it. It was the fault of small-time retail investors getting in over their heads. But behind the curtain, the pressure points are calculated. The leverage is deliberately seeded into the system. And the exits are timed with precision by those who designed the game. So I want you to ask yourself, are we really wiser now, or are we just walking the exact same path, only this time in better suits and with faster computers? The stage is bigger, the numbers are astronomical, but the plot feels eerily familiar. If you've watched this far, you're probably the kind of person who doesn't just accept the official story. You like to look deeper. So I want to hear from you. Comment below. Do you believe our markets are designed to create sustainable growth for everyone, or are they designed to extract wealth for a select few? Make sure you subscribe and turn on notifications for the next breakdown. We're just getting started. Thanks for watching.